Hello, and welcome to Trade Your Mind. Today we're talking about something every trader faces, but few ever master: the psychological traps that stand between you and consistent profit. We've all heard the stories. The average trader loses money, and the statistics are shocking. Studies show that over 70% of retail traders lose money every year, and less than 10% are consistently profitable. The question is, why? It's not just about the charts or the news. The real battlefield is inside your own mind. In this episode, we'll explore the 10 psychological traps that trip up both new and experienced traders. If you've ever wondered why you keep making the same mistakes, this is for you. Trap 1. No trading plan. The first and biggest mistake is trading without a plan. Think about it. Would a pilot fly a plane without a flight plan? Of course not. But many traders jump into the market with no clear strategy. Without a plan, every trade is just a guess. You're trading based on emotion, not logic. A solid trading plan tells you what to trade, when to enter, when to exit, and most importantly, how much risk to take. It's your rulebook, and without it, you're just gambling. Trap 2. Poor risk management. This trap is about survival. Your number one goal as a trader is not to make a lot of money, it's to stay in the game. Poor risk management, like using too much leverage or not using a stop loss, can wipe you out in a single bad trade. A famous trader once said, "The secret to making money is not to lose it in the first place. Set a stop loss order on every single trade. It's an automatic exit point that protects you from a big loss. Don't move it, don't ignore it. It's your safety net." Trap 3. The fear of losing, loss aversion. This is a powerful psychological bias. The pain of a loss feels twice as strong as the pleasure of a gain. This leads to a common mistake called the disposition effect, holding on to losing trades, hoping they will recover, while selling winning trades too early to lock in a small profit. You hold a losing stock, watching it fall, telling yourself, "It'll come back." Meanwhile, you sell a winning stock quickly because you're afraid the gain will disappear. This simple human emotion is why so many traders fail. You have to learn to cut your losses and let your winners run. Trap 4. Chasing the crowd, FOMO. Have you ever seen a stock soaring and felt like you have to buy in right now, or you'll miss out? That's FOMO, or the fear of missing out. This leads to impulsive trades without any real analysis. Everyone rushes in, drives the price up, and then the smart money sells, leaving you holding the bag. Remember the famous quote from Sir Isaac Newton, who lost a fortune in a market crash. "I can calculate the motion of heavenly bodies, but not the madness of people. Don't let the crowd's madness control your decisions." Trap 5. Overconfidence. After a few winning trades, it's easy to feel like you're a genius who can't lose. This overconfidence leads to taking on bigger and bigger risks. You might start ignoring your rules, using more leverage, and trading impulsively. This is exactly what happened to Nick Leeson, the rogue trader who brought down Barings Bank. After a series of successful trades, he became overconfident, hiding his losses and making bigger bets, which eventually led to a massive failure. Remember, a winning streak is just a series of events. It doesn't mean you can't be wrong. Always stick to your plan, whether you're winning or losing. Trap 6. The Holy Grail. Illusion. Many new traders are constantly searching for the perfect strategy or the holy grail that never fails. They jump from one strategy to another, from one indicator to the next, never truly mastering anything. The truth is, there is no perfect strategy. The most successful traders don't have a secret formula. They have a solid, repeatable system and the discipline to follow it. Stop chasing the next big thing and focus on mastering one approach. Trap 7. Impatience and overtrading. A lot of traders think they have to be in the market all the time to make money. This leads to overtrading, taking too many trades, even when there are no good opportunities. This is often driven by boredom or the need for constant action. As a result, you pay more in fees and take on bad trades. Sometimes the best thing you can do is do nothing. Wait for the right setup. The market will always be there. Trap 8. Confirmation bias. This is when you only look for information that supports what you already believe. If you think a stock is going to go up, you will only read news articles and listen to experts who agree with you. You ignore any information that might suggest the stock will fall. To avoid this, Actively look for opinions that disagree with you. Try to find reasons why your trade might fail. This balanced view will help you make better decisions. Trap 9. Unrealistic expectations. Many people start trading thinking they can get rich quickly. They see it as a lottery ticket, not a business. This leads to unnecessary pressure to make huge profits, which results in taking on more risk than they should. Successful trading is a marathon, not a sprint. It takes time, patience, and continuous learning. Focus on small, consistent gains. Your goal should be slow and steady growth, not overnight riches. Trap 10. The sunk cost fallacy. This is the psychological trap of holding on to a losing trade just because you've already invested time or money in it. You think, I've already lost so much, I can't sell now. But the money you've lost is gone forever. It's a sunk cost. The only thing that matters is the future potential of the trade. If a trade is no longer good, let it go. Don't let past losses influence your future decisions. Conclusion. Your path forward. These 10 traps are not just mistakes. They are symptoms of a deeper problem, a lack of psychological control. The market tests you every day, not just on your skills, but on your discipline, patience, and mindset. If you recognize any of these traps in your own trading, don't be discouraged. The first step to fixing a problem is understanding it. Start by creating a solid trading plan, focus on managing your risk, and work on developing a disciplined mindset. The charts, the news, the systems, they're all tools. But the most powerful tool you have is your own mind.